All right, guys, in this episode, we're going to cover probably one of the most important things in trading. And this isn't technical analysis. This isn't the strategy. This is actually applying the strategy, having the right execution and confidence and conviction to actually continue to do the same thing over and over and over again, even when it doesn't always work right away. Now, what I'm talking about today is psychology and risk management. And these are the two things that when I finally was able to master, that's when my trading really took off. The strategy was obviously an important part. You want to make sure you are trading the right strategy, you have the right information, you have the right knowledge, you know how to pick the right stocks. But after that, you have to start piecing everything together. And it's not as easy as you might think, because when you have real money on the line, what's going to happen when you're down $5,000, $10,000, $20,000? How are you going to react when that happens? A lot of people don't know that when they're in a trade, they have to end up having these emotional decisions that end up coming up. But the thing is, you always want to stick to your system, which is why it's so important to understand how psychology works. Because the truth is, if you can build good habits the right way, right away as a trader, you're going to be having an advantage over 99% of people. If you can actually commit to building the right habits, you're going to see so much improvement. You're going to actually see that the strategy is going to work over time, and you're going to actually have consistency within your trading, which is probably the most important aspect of trading. Now, what is trader psychology? Trading psychology just refers to the fact that we are emotional creatures, right? Every single candle that you actually see on a technical analysis chart is from the fact that there are emotions within humans, right? It's showing you the emotions, it's showing you the decisions that traders ended up making. Now, trading is one of the most emotional and hard and straining skills there pretty much is out there, because at the end of the day, think about it, you're risking your hard-earned money. If you're putting your money on the line, you're going to have some emotions that come into it. Nobody wants to end up losing money. The thing is that you have to understand is that trading is unlike any other job out there. You could work super hard, you could do the right thing over and over again, and you can still lose, because in trading, nothing is ever 100%. In life, you're pretty much taught to always be right. When you're taking tests in school, you have to be right on every single question to pass the test. And the more you're right, the more you're rewarded. In trading, it's actually not like this. In trading, it's okay to lose. And most of the time, the best traders in the world actually have a less than 50% win rate, meaning that they win less than 50% of the time, but they still make a ton of money. Now, you might be confused how the math works on that. Well, the fact is, what they're doing is called using a high risk to reward, meaning their losers are very small. So even if they lose 5 trades in a row and they lose $100 per trade, they lose $500. But their winning trades make 3 times their losing trades. So if they win 5 trades, now they have a 50% win rate out of 10 trades. Their winning trades are $300, so they make $1,500 on all those 5 winning trades. And then if you minus 1,500 by 500, that comes out to $1,000 that they end up making, even with a 50% win rate. And that is considering the fact that they're not even having much bigger wins. And this ties into risk management being the holy grail of stock trading. If you can manage your drawdown, if you can manage your risk, and you can have a parameter for how much you're going to lose per trade, you're actually going to have almost unlimited upside on your trades. Because the thing is, if you can let your winners run and you can cap where your losers are, you can have trades that end up running for months, years, and even go thousands of percents higher. I'll tell you a quick story. In 2024, this is when I had a $50,000 account. And at the time, to me, that was a lot of money and pretty much all the money that I had saved. And I really wanted to grow my account. Thing is, I was looking for trades to grow my account. I was looking for home runs. And the thing is, I started to realize as I went on with my trading, I'm not going to hit a home run. All I have to do is be disciplined and continue to do the same thing over and over again. And eventually the market will put me in a position to be quote unquote lucky to hit a trade that ends up changing my account. Once I started to realize this, I actually did hit an account that ended up really changing my account. And this was NVIDIA in 2024 when it broke out of its big base, made a massive move. And I was able to 5x my account by being at the right place at the right time, but not by trying to full port every single trade, by actually using a system that made sense, by cutting my losers quickly, letting my winners run, and then letting the account compound. Now, our goal as traders is to make trading as emotionless as possible. So what you want to think about is building a system When you have a system and you have confidence within that system, what ends up happening is now you actually have conviction to hold on to trades or cut the trades whenever you know that the trade is going against you. Because if you don't have conviction and if you don't have a thesis and you don't know why you're doing the things that you're doing and there's no plan behind your trading, you're not really going to know if this is the right time to cut the trade or if this is the right time to sell the trade, right? But if you have a thesis, if you have a plan before you even take the trade and you have a system there that actually tells you, okay, this is the right time to cut, this is the right time to sell, now you're going to have conviction, because what you've seen over the last few months or over the last few years is your system does generate you proven results. Now, this is why it's incredibly important to build good habits and have a consistently proven strategy, because of the fact that you want to see that it works. If you don't see that it works and if you don't have confidence, you're going to continue to make bad decisions and mistakes. If I know all I have to do is stick to my system and I'll make $1 million at the end of the year, why would I deviate away from my system to make a quick buck if I know that all I have to do is literally stick to it and make that money over time? And that's what I tell myself every single time I enter a new trading day. If you stick to the system, if you stick to the rules, if you have the discipline to do the same thing over and over and over again, your system will end up benefiting you. So what do you want to do? Well, first thing is you want to make sure you're creating a plan. You want to create a strict set of rules and guidelines that you could use for your trading day. So here's an example of a plan. If the stock breaks this level, or if the stock tests this level, then I'm going to enter this position and I'm going to put my stop loss at this level and I'm going to exit at this level if this level hits. Now, the reason why you structure your trading plan like this is because of the fact that now you know what to do and you're taking off pretty much all the emotions off the table and everything is extremely objective. Most important thing is to enter each and every trade with a game plan. When the market's open, you should already have a list of stocks and an idea of the trades that you're going to take, or at least know the stocks you're going to watch. That way you come into the day prepared, and now all the emotions are taken off the table and you can react to what price is doing and not try to predict, not try to chase, and have all this FOMO. Another incredibly important concept to understand with trading is that every day is a new day. Don't go into Tuesday trying to fix Monday's mistakes, because all that's going to do is make you dig a deeper hole over and over again. What you actually want to do is something that most people don't do and most traders actually don't understand. Now, this concept is called progressive exposure, and it's one of the most important things I learned when it comes to trading. And what this actually looks like is whenever you're losing and have a losing streak, you actually size down. That way you manage your drawdown, you control the downside. Whenever you have a good streak and you're making money and things are working well and you have some positions and profits, now you can start to slowly size up and size up. Now, that doesn't necessarily mean get overconfident, right? Because the market's going to humble you, but you're doing more of what works and less of what doesn't. And if you have a bad trading day, don't come into the next day trying to make up for it. Maximize what's in front of you, trade what's in front of you. Every single day is a new day, every week is a new week, and go into it thinking about the next trade. The last thing you want to do is always think about the trade before, what you could have done, and all these little different things. Journaling is incredibly important in seeing what you could have done in the data and collecting that as well. But you don't want to go into the next trade thinking about what happened in the trade before. What you want to think about is how can I maximize the next trade that's in front of me, making sure that I stick to my rules, making sure that I have the right entry, making sure that everything that I plan for the trade goes according to plan. Avoid digging yourself a deeper hole, especially as a beginner trader. You don't want to end up in a $5,000, $10,000, $100,000 loss for no reason, because then to even become profitable, you literally have to climb out of that hole and make just that money back to get back to break even. Think about it. The more money you lose, let's say you have a $10,000 account, if you lose 50% of your account, you actually have to make back 100% to even get back to break even. Now, to make money, you'd have to make over 100% just to make money in the markets. This is why drawdown control is the most important thing and managing your risk is the most important thing, because if you take too much of a drawdown, you have to make so much of it back just to get back to break even and just to make money. The most important thing is focusing on becoming profitable. Think about trading as a machine. Let's say if you had a furnace, why would you put money into a furnace if all that's going to happen is that money is going to get burned? A lot of traders think, oh, the more money I have, the more money I'm going to make. Well, actually think about the opposite. The more money you have in your account, the more money you can actually lose. Focus on making your trading system and trading an ATM. Now that you have an ATM, the more money in the ATM, the more money you can pull out. But you have to focus on becoming profitable. You have to focus on having consistency. You have to focus on making money 1 month in a row, 2 month, 3 month, 4 month, 5 months in a row, and the whole year, and seeing if you can actually make money over the long run. That is when you want to start adding into your account and slowly building that up. So many people get stuck in the mentality of thinking way too short term. You want to think of trading as a marathon, not a sprint. One of the most important things that I learned in the market is the market is always right. A lot of traders try to think that they're smarter than the market, and they always have to think about like a reason for why things are moving the way they are. Oh, there's a headline here, there's a thing there, there's a geopolitical thing over there. But the truth is, the market is going to move, and price action a lot of times does precede the news. You always want to respect what price is doing. This is why using a stop loss is so important. Our goal as traders is not to predict what the market is going to do contrary to popular belief. It's actually to find the highest probability setups, acknowledge the fact that they can go wrong by managing our risk, and then put ourselves in a position to have the highest probability setups with the lowest risk possible and the highest reward possible. The worst thing you could do is think that every single trade has to go your way, because the truth is, nobody is 100% right. Even the best traders in the world that have made millions and billions of dollars, for example, Warren Buffett, he was not always right. Be able to accept that price might go the other way, and it's okay to take a loss. Now that you understand a little bit about the psychology and the foundation of the way that you should be thinking when it comes to trading, let's get a little bit more into managing our risk. If anything we've talked about so far in the series resonates with you, and you know that the path to profitability is to become a swing trader, then what I want you to do is go down to the link below and grab a seat for the live 3-day swing trading challenge, where I'm going to show you exactly how to place your first profitable swing trade and teach you everything you need to know about the $2.5 million system that I personally use and that I've taught to thousands of other students. Now, I can't guarantee that you're going to become a profitable trader after this challenge, but what I can guarantee is the risk of staying exactly where you are is higher than joining a challenge like this. Because the truth is, you can keep doing the same thing that you were doing before and wasting your time year after year, or you can use an actual proven framework that has worked for hundreds of other traders and myself to become consistently profitable without having to take massive risks in the market. If this sounds like something you're interested in, make sure to go to the link down below and grab your seat for the live trading challenge. Now, without further ado, let's get back into the video. All right, so what does risk management look like? First and most important thing, we have to figure out where to put our stop loss on a trade. Now, if you watch the entry and exit video, you'll know that all my stop losses are at the low of the day on the day that I take the trade. But why is that? Why do I put my stop loss there? Well, the reason I'm putting my stop loss at low of day on most of my trades is because it makes sense. This is where most trades, if they come back and take that low of day out, they're probably going to fail and make a big move the other way. Now, of course, this isn't always 100% true. Sometimes low of day gets taken out and then the stock ends up moving in the direction of the trend. But I want you to think about this concept really quickly. You can always re-enter a trade after it fails, but you can't go back in time and wish that you would have taken the position off when you have a massive loss. This is why stop losses are so important, because you can lose 2% on a trade and literally get back in, let's say 1% higher up, and still make a good amount of money if the trade does end up working. But you can't go back in time when you have a 50% loss and then wish that you would have taken the trade off. This is why keeping your losses small is so easy on your mental and your psychology, because you have a max limit of how much you could lose and you can actually be comfortable with it. Let's say you have a $10,000 account and the max you want to lose on a trade is $100. That's about 1% of your account. Now you know that the max you could lose on a trade is $100. So you have to figure out, right, how can I make sure that I don't lose more than $100 on a trade? And this is where the low of day stop comes into play. So how does this look like? Well, first of all, you can use a tool on tradingview.com. It's going to be one of the easiest, or on your broker, to manage your risk. So for example, this is a trade that I took on the ticker NVIDIA when it broke this day's high. This was a classic higher day break. From our entry and exit video, this is a breakout trade. The stock takes out this high right here. And I was going to use the low of the day as stop loss. The reason why is because if it broke this level, it was probably going to fail the trade. Now, you could use any stop loss that makes sense for you. I like to use stop losses that are either a key level, the moving averages, or low of days, usually like 80 to 90% of the stop loss that I use. Now, the thing is, sometimes the low of day might be a little bit too far away for the trade to make sense. So for example, if I'm entering NVIDIA up here, which obviously I probably shouldn't be because that's a little bit of a chase, low of day stop loss might not make sense because look at how far away it is. But in this case, it did make sense. So I took the trade right here and my stop was at low of day. Now, this tool tells you exactly how much you're going to risk and how much you are going to lose if the trade goes against you. So for this example right here, you can see you're going to have a 1.9% loss on the trade if your stop loss ends up hitting. Now, let's say you're trading about 100 shares of NVIDIA. Now, the price per share of NVIDIA is about $216. So you'd be risking about $21,600 on the trade. So now all you have to do is see how much is 1.9% of the number that you're potentially putting in on the trade. You hit calculate and you see that you're risking about $410 if the trade hits your stop loss. Now that's incredibly important to know because now you have an idea of how much you can potentially lose if the trade goes against you. And you have to ask yourself, does this make sense? Is this more than a potential risk that I'm willing to take? Now, as a guide of the framework that I usually take for risk per trade, I usually don't risk more than 1% of my account, and that's in really, really good market conditions. So my personal rules is I have tier systems in terms of my sizing. Whenever I have a lot of good positions working and things are working really well for me and the market is hot, I risk about 1% of my account per trade. Now, that doesn't mean that I'm sizing 1% of my account per trade. That is what my stop loss is at. So for example, if I'm risking 10% of my account on a trade, that means I can't lose more than 10% on that trade because that would be 1% of my account. But if I have 20% of my account in a position, now I can only lose 5% on that 20% of my account because that comes out to that 1% risk. So your risk is actually determined by the distance to stop loss. The tighter the stop loss, technically the more I can risk on the position because it ends up coming out to a small percentage loss as long as the stop loss is a pretty tight stop. Now, once I understand, all right, am I able to risk $410? Does this make sense? Now we can move on with the trade, but we have to make sure that the reward makes sense as well. So I'm always looking for at least a 1.5 risk to reward for the trade to even make sense as a first target into strength. Now, if you watch the exit and entry video, you'll notice that I don't really trim much into strength other than the first target because I want the moving averages to do most of the work, but I need to at least have a 1.5 risk to reward when I trim. That way it satisfies my RR. Now, let's say you're looking to trade options and you want to figure out, all right, how much am I going to risk per trade with options? How am I going to manage my risk with that? It's going to be the exact same concept. So what you want to do is pull up your broker and you want to find the option strike that you like to trade. I usually like to trade about 1 month out options. So I'll click right here on the next OPEX expiration on NVIDIA because that's the one that I usually want to trade. I usually like to trade the ATR out the money, and you can see for this stock right here, we have a 5.68 ATR on NVIDIA and it's trading at about $216. So that would put it at about 220, 221, 222-ish. You can see we have the 220 strike right here, which makes sense. So what you want to do is you want to right click on this and you want to see and view the actual chart of the option. All right, so once I pull up the chart of the option, now we can have the chart of the stock and the chart of the option side by side. And what we could do is actually gauge how much the option is going to be worth at the low of the day to know how much we could potentially lose on the trade. So for this example, let's say we would have bought the stock right here at 1.78 because that was the high of daybreak. The stop loss and the lowest point of the option was at 0.95. That means from 175 to 0.95 would have been your loss. Now, again, you can go back and calculate this. You can put from 175 to 0.95, how much would your loss be? And that would be about a 45% loss. So for me personally, that is way too big because that usually means I can only size like 2% of my account on the trade. If I'm taking a 45% loss, that's going to be less than 1% of my account. But even then, the risk to reward doesn't really make sense much. I usually like to keep my options losses to less than 10-15% and keep them super tight, which is why it's so important to have a good entry near the low of day or near a key level. That way you could use that as your stop loss. You could also use an options calculator or a calculator for your shares as well to see how much you could potentially lose on the trade and how you could size into a position. Now that we understand risk management, we can start to put everything together with this strategy, start looking for the right setups, start looking for the right stocks. And then from there, we can find the best stocks in the market and the best themes using our screener, using our scanner. And then we can execute using our simple entry models. And then from there, we can use our simple exit strategy. make things simple, repeatable, and scalable. And this is how trading should be, guys. So if you enjoyed this series, please leave a thumbs up, comment any more ideas that you want me to post in terms of videos. I hope this was able to help you, and I hope that you enjoyed. And don't forget, the 3-day live swing trading challenge is coming up in the next few weeks. If you want to attend that, if you want to really level up your trading, do so down below, and I'll see you all there. Hope you enjoyed the series.